Mike Amey, you're managing director at Pimco in London. After tendency in the polls of Britain leaving the EU, we had the probability of a Brexit falling just to 20% this week, according to the bookmakers. So how do you see the sentiment shortly before the vote?
Yes, I think there has been a material shift in sentiment over the end of last week and the beginning of this week with this move in the polls back towards a higher likelihood of staying in. I mean, we, for example, have really from the start assigned a 60% probability that we would vote to stay in and a 40% probability that we'd vote to leave. Markets have shown a lot of volatility around that. At the moment, as you say, it's about 80-20. So we're in one of those periods where the markets seem very confident that we'll vote to stay in. And frankly, I hope we do.
Let's look at the possibility of a Brexit. Some market participants see the pound fall by around 20% against the dollar and the British stock market falling by 30%. What do you think? Would it bring chaos to the financial markets?
So we do not think that in the event that we vote to leave, that it would, to use your quote, that it would bring a serious amount of market volatility. And the reason for that is you have to think about what would happen after a Brexit. We would probably have a change of prime minister. There would be a minimum 2-year negotiating window. We actually think it would be quite a lot longer than that because it's a very tough arrangement to unwind. So we think this would be a multi-year event. And I think that's quite important when you think about the market response, because markets, get themselves into serious downturns when there is a short, sharp, unexpected shock, and this wouldn't necessarily be that creates a fundamentally different global macroeconomic backdrop.
In case of a Brexit, it could weaken the pound. Would this help to boost the economy?
Yeah, so we think that if we did have a Brexit, that the pound would probably drop by around about 10% against the dollar, probably less against the euro or the Swiss franc, simply because there would be an element of Brexit risk in the euro in particular. So a 5 to 7% fall in the trade weighted would support the economy. I think the bigger influence of the economy would be the hit to confidence and business confidence in particular. So I think business investment would come down, maybe consumer spending would come down a little bit. So the weakness in the currency would provide some offset, but I think the dominant factor would be the hit to confidence. We think GDP would probably fall to around about 0 or slightly above 0.
What would a Brexit mean for the Swiss banks? Would they have a huge capital inflow since investors would want to keep their money out of Britain?
I think for the Swiss banks, there would be two influences. I think there would be some money that would go into the Swiss banks as a safe haven as much as anything else. Don't forget that the Swiss franc, as we know, is one of the classic safe haven currencies. So I think you would see money leave the UK. We don't think there would be a serious capital flight out of the UK, but I think it's right that that Swiss banks and Swiss franc investments would be one of the beneficiaries. And I think the Swiss franc would certainly be stronger on Friday in the event of a Brexit. Yes.
You mentioned earlier the likelier outcome of the vote is that Britain will stay in the European Union. How would the market react in that scenario?
I think we got a bit of a playbook of that on Monday. I mean, you saw equity markets up by 2 to 3%. You see risk-free rates sell off by around about a percentage point or so. Sterling obviously rallied quite hard. We would say, as we look here now, the things we tend to look at are things like sterling against the dollar, which we think would probably go back to 150, 155. Maybe the bond market would sell off another point or so. Equities probably do another 3 to 5%. Because even if the markets are, an 80% implied probability on the bookies, this is a binary event. So we think there would be a move whether we vote to stay in or vote to leave.
And my last question, if you look at investors, how should they position themselves in this moment?
Well, there are certain parts of the market which have kind of moved and have quite a high risk premium on a Brexit. For example, things like the UK banks, UK bank bonds, so riskier parts of the banking structure. You can get yields of 8% on UK major banks, which to us is like a very attractive opportunity. So we think that's a good thing to own. But you don't want to be all one way. On a binary event, you need to have some protective positions on the other side in the event that we did vote to leave. So where we do own those bank bonds, we think there are two trades you can do to protect yourself and provide some cover. One is we think the Bank of England would cut rates actually in the event of a Brexit because the economy would slow down. and the sterling currency obviously would take a bit of a hit. So what we like is a basket of those high-yielding UK bank bonds with a little bit of a currency underweight versus the dollar and some exposure to short and intermediate UK gilts, which we think would rally buy more in the event of a Brexit, and they would sell off in the event of a stay.
Mr. Amey, thank you very much.
Thank you.